Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Nebius Group.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis of Nebius Group.
Okay, where do we even begin with this one? The numbers are pretty staggering.
They really are. And I think you have to start with what Nebius actually does.
Right, they're not just another cloud company.
Exactly. They position themselves as a full-stack AI infrastructure provider. Some people are even calling them a neocloud.
A neocloud. So what does that mean in simple terms?
It means they're not for, hosting your website. They build these highly specialized environments for GPU-heavy workloads.
The kind of stuff that powers all this new generative AI.
Precisely. They're basically the private superhighways for the AI economy, and that specialization is showing up in the numbers.
Okay, so let's get to those, the top line growth.
Looking at the third quarter of 2025, their revenue hit $146 million.
Which is a solid number, but it's the comparison that's wild, right?
It is. That's 355% year-over-year growth.
355%. That's not just growth, that's hyper growth.
And it gets better.
Mm-hmm.
If you dig into their core infrastructure business, which is almost 90% of their revenue,
Real engine.
that part is accelerating even faster, 400% year-over-year.
Wow.
It shows you exactly where the big money is going, straight into that specialized compute.
And this is the critical part I saw. They can't even keep up with the demand.
No, that's the kicker. Management said it themselves on the earnings call,
What was the quote?
that their revenue growth was, and I'm quoting here, limited only by the capacity we were able to bring online.
So think about that. Your only problem is you can't build data centers fast enough.
It's a supply problem, not a demand problem.
Uh-huh.
They are literally sold out before they even flip the switch.
Which brings us to their forward guidance, which seems almost unbelievable.
It's aggressive, for sure. They're targeting between $900 million and $1.1 billion in annual recurring revenue for 2025.
A huge leap from where they are now.
A huge leap, but that's just the appetizer. The number that's really making everyone's head spin is the 2026 target.
Okay, what is it?
They're projecting $7 to $9 billion in ARR by the end of 2026.
7 to billion. Wait, that's like a 7 to 9 times expansion.
In 1 year.
How is that even possible? I mean, what has to go right for that to happen?
Everything. Perfect execution on logistics, on supply chains, construction. They cannot have any delays.
Which makes sense why everyone is so focused on their spending plans and whether they have a real competitive advantage, a moat.
Exactly.
Yeah.
Is this just a commodity business, or is there something real and sticky here?
So what's the verdict on that? Do they have a moat?
I'd argue yes, for now.
Yeah.
And the moat isn't technology, it's scarcity. Think about it. This isn't commoditized cloud space because the specialized capacity is completely sold out. They've locked in the biggest spenders in the world.
Which creates switching costs.
Extremely high switching costs. We're talking about multi-year, multi-billion-dollar contracts.
Let's get specific on those contracts because they're a huge part of the bull case.
They are. We know of $3 billion in committed revenue from Microsoft.
$3 billion.
And another $3 billion committed from Meta.
So that's $6 billion of guaranteed visible revenue already on the books from just 2 customers.
Two of the biggest tech giants on the planet. Yeah.
Mm-hmm.
That kind of commitment is a massive barrier to entry for anyone else.
It's a huge vote of confidence.
It is. And it's not just about the space. It's about the hardware inside. They have a technological edge with their AI Cloud 3.1 platform.
What's special about that?
It's deeply integrated with NVIDIA's Blackwell Ultra capacity.
So the absolute newest, most powerful stuff, the bleeding edge.
The absolute bleeding edge, which is the biggest bottleneck in AI right now.
Yeah.
They're not just selling compute, they're selling the most sought-after compute.
Okay, but let's play devil's advocate. The bear case says there's no moat because this is all just capital.
Right. Anyone with enough money can just build data centers and buy GPUs.
So what stops an Amazon or a Google from just doing this themselves and cutting Nebius out?
For now, it's speed and supply. The contracts and the capacity they've already secured are the moat.
An execution moat.
Exactly. They have the supply that no one else can get their hands on quickly, and it's locked up for years. That window might close eventually, but for today, it's very real.
Which leads us to the money. How are they funding all of this? Let's talk financial health.
And this is what's so fascinating. Despite the spending, their balance sheet is surprisingly strong.
How strong?
Total assets over $3.5 billion.
Yeah.
But the key number is their net debt position.
Which is?
It's negative, about negative $2.4 billion.
So for anyone listening, that means they have $2.4 billion more cash on hand than they have debt.
Right. It gives them incredible flexibility.
But they're burning through that cash very, very quickly.
And that is the absolute core of the bear case.
Yeah.
The reinvestment strategy is incredibly aggressive.
You're talking about the CapEx guidance.
Yes. They raised their 2025 CapEx guidance from $2 billion all the way up to $5 billion.
A $5 billion shopping spree.
It tells you two things. One, demand is even higher than they thought. And two, they are prioritizing market share over any kind of near-term profit.
So that leads to negative free cash flow.
Correct. And we saw their net loss widen in Q3 to about $120 million.
So how should we frame that? Is the company just unprofitable?
I wouldn't say that. This is a strategic land grab. They're spending now to secure a dominant position for the next decade. It's a deferred profit model.
Is there any sign that the core business can actually be profitable?
Yes, and this is the important part. While the group as a whole is losing money because of the huge CapEx,
the core infrastructure business itself actually hit a 19% adjusted EBITDA margin.
19%. That's very healthy.
It's very healthy. It shows the underlying model works. And they expect the whole group to reach slightly positive adjusted EBITDA by the end of 2025.
That's a huge inflection point for the market to watch.
It's critical. But to get there, they might need more cash, which brings up dilution risk.
They set up a plan to sell more shares, right?
They did, an equity distribution agreement to sell up to 25 million Class A shares.
And they're doing it through an at-the-market or ATM offering.
Yes, which is the smart way to do it.
Can you explain that quickly?
Sure. Instead of one big disruptive stock sale, an ATM lets them sell smaller batches of shares into the market over time at current prices.
So they can raise cash when the stock is performing well, opportunistically.
Exactly. It reduces the risk of a single event that just crushes the stock price. It's a much more flexible way to fund this kind of expansion.
Okay, let's pivot to the charts. The stock itself, it's been on a wild ride, an incredible run. I mean, up over 200% year to date.
But you don't get that kind of move without some serious volatility.
Definitely not. We recently saw a pretty sharp 30% pullback from the October highs.
And it's been trading in what, the low to mid 80s?
That's right. But that pullback has actually formed a technically constructive pattern,
What are you seeing?
a higher low pattern. And importantly, the 200-day simple moving average has been holding its support right around $83.
So that's the long-term trend line that big institutions watch.
It is. And it suggests that buyers are stepping in aggressively in the low 80s, seeing it as a value zone.
And what's the level to watch on the upside? The resistance?
The $100 to $110 range. A strong break above that would signal the next leg up is starting.
But there's some sentiment overhang, right? The insider selling?
Yeah, it's definitely contributed to the pullback. You see these filings, even small ones.
Oh.
There was one for just 500 shares.
And that one was a sell to cover, wasn't it? For taxes.
It was. But the market doesn't always care about the reason. It just sees insider selling and gets nervous. It creates noise.
And that noise is amplified by the short interest.
Massively. The short interest is elevated. About 15.5% of the float is short.
Which is much higher than its peers.
Much higher. It means there's a very crowded group of traders betting this whole thing will fail.
Betting the CapEx is a mistake or the guidance is impossible.
Precisely. But that also creates a very explosive setup.
A potential short squeeze.
A huge one. If the company delivers good news and proves the bears wrong, they all have to rush to buy back their shares, which just throws gasoline on the fire.
It makes it a true high-risk, high-reward situation.
Exactly. So with all that in mind, let's talk catalysts. What do we need to watch for in the next few months?
The number one event has to be earnings, right?
Without a doubt. Q4 2025 earnings expected in early February 2026. That is the moment of truth.
The market will be demanding proof.
They need to show they're on track for that $900 million to $1.1 billion ARR target for 2025. A miss there would be bad.
But the real focus will be on 2026.
It's all about 2026. They need to reaffirm that $7 to $9 billion guidance with confidence. Any hint of a walkback would be catastrophic for the stock.
In beyond earnings,
We need updates on the CapEx deployment. Is the $5 billion being spent on schedule? How quickly are the Microsoft and Meta contracts ramping up?
We're looking for signs that the physical build-out is matching the financial projections.
That's the whole story.
Yeah.
So if you're an investor looking at all this, what's the takeaway?
Well, it feels like a truly asymmetric bet.
It is. It's high beta.
Yeah.
The risk is immense because the spending is staggering and the targets are so aggressive.
But the reward, if they pull it off.
It's equally massive.
Yeah.
This is a multi-year hold that is purely a bet on whether that 2026 ARR number is real.
It's the ultimate execution story in the AI space.
It really is. The losses, the volatility, that's just the price of admission for a company trying to build something this big, this fast.
So, a final thought to leave people with. The scale of this AI infrastructure race is it's almost hard to comprehend.
It is. This is a battle to become a foundational pillar of the next great technological shift.
And these next few months, especially those Q4 earnings, will be the test. Will the capacity arrive on time to meet that committed demand? That's the entire investment thesis in one question.
It is. And if you want us to look into another company like this, just let us know in the comments. Make sure you subscribe to stay on top of the stories as it unfolds.